Like, let's say the dot-com top, NASDAQ 100, for example. When it turned down, S&P went down 2 years to 2002, 50%. NASDAQ 100 went down 82%. You talk about cleansing, okay? And it wasn't that what it was up there for was wrong. In fact, the dot-com bubble was totally valid. It changed our lives more than people even thought, and the internet did. And yet it still erased 82% of it, and it took it till 2016 for the NASDAQ to even get back to the price it had been in 2000. So, the point being that a lot of these things that happened, like if the stock market's going to top, as we argue it's topping, or the monetary metals are going to accelerate now, it's because of not factors that are necessarily new headlines, but old stuff that's finally getting recognized. And I think that's where we are, at a very dramatic point, especially for silver. It's an ongoing bull trend that's, everybody tries to find in any market trend a reason for it. And usually the reasons for a bull trend or a collapsing market, either way, is one, they got too extreme for too long, either too high or too low. In case of silver, we argue, too low for too long, especially on a relative basis to gold. And then when they turn up, they don't need a reason. The reason already occurred and was ignored. And so people are looking for a headline like, well, why is silver gold? Why is gold going up? Why was this stock, et cetera, et cetera. And usually it's stuff that's embedded, already built into that market that it needs to do. Okay, anyway, that's a broad comment, but I think it applies. The ongoing thing of gold and monetary metals, and I call them monetary as opposed to like platinum, palladium, which are precious, but there's a difference between precious and monetary. 3,000 years of history of gold and silver being money, okay? If you look at, go to a Federal Reserve St. Louis, their FRED chart, they call them, and go to an M2 chart, money supply, okay? And just look at it. Go back 50, 70 years, however far back they go, a long time. And look at, and move your little arrow along and go to the first of the decade, January of 1970, and then go to January 1980 and 90, and write down the number. What was the money supply then? It's parabolic. Okay. And meaning the decay in the real value of the stuff in your wallet. We're a miniature, most countries in the West are, miniature versions of Venezuela. Okay, we made fun of that a couple of months ago. We put a Venezuelan stock chart on page 1 and said, boy, we should be long Venezuela.
A central driver of precious metal strength is the relentless expansion of money supply. Over past decades, Western central banks have repeatedly injected liquidity, effectively diluting the real value of cash. This erosion encourages capital to seek refuge in assets less prone to debasement. Gold and silver, unlike many commodities, carry a monetary legacy stretching millennia. As faith in fiat currencies weakens, demand for monetary metals strengthens. In today's macro climate, that dynamic is intensifying. New gold highs and rising silver interest reflect this flight from currency risk.
Because the chart is parabolic, the stock market. You say, well, that's great. No, it's not, because the degradation of the money ongoing constitutes the explanation of why the thing's going straight off the page. So is the price of dog food or a roll of paper, was exploding as well. Well, when you go back, that many decades in the U.S., basically the money supply increases about 90%. Almost doubles, in other words, every decade. Sometimes more, sometimes less, and especially when the central bank gets nervous about this, that, or the other data point. Usually that's associated with the stock market downturn when the data points really start to go sour. Then they start printing more, okay? Well, gold goes up and holds its value against that ongoing degradation. And silver does too, although it's been lagged, especially over the last couple decades, to what gold has been doing. Gold's way above its 2011 high. Heck, copper is above its 2011 high. And there's a lot of base metals out there that if you circle where you are now and go back to where, 10, 20, 30 years ago, you think, gee, silver. Silver has made a mistake. investors in silver have made a mistake. This happens in markets. You've got enough experience. If you go back to 2007 and 8, the market collapsed for reasons that, the guys in the story, they knew why it was going to collapse. They knew a couple years ahead of time, and yet the market wouldn't do it. And then finally it did collapse and paid its dues for that which it already had done and failed to compensate for. So I think silver right now is in one of these situations where not only is monetary metal going up, gold especially, the mama market, and silver's coattailing it, still very undervalued to gold, but it's catching up and it's erasing years of underpricing relative to a lot of things, to gold, to the degradation in the money unit. For example, if you just arbitrarily go back a quarter of a century, it'd be the October of 2000, okay? And look at the S&P. Right now it's up 3.5-fold from where it was then. It's actually less than the degradation in money almost. Gold's up 11+-fold, okay? So it's held its value against degradation of money. And that's a factor that's ongoing in all markets. And there's times when, let's say, the stock market reaches a bubble point where it's been ridiculous for too long, overpriced versus reality. And there's a lot of fundamentals out there that, that normally look at, the earnings and so forth. And those don't seem to work precisely, but they're a ballpark warning. And yet it's still up there. So markets make mistakes, and when they do, the erasure of that mistake is often horrendous.
Historically, silver has traded at a steep discount to gold. During extended bull markets, that discount often narrows. Silver outperforms in percentage terms. Now, many investors see silver as undervalued relative to gold's explosive gains. As gold marches upward, silver begins to ride its coattails, but with amplification. This convergence phase is often among the most aggressive in a precious metal cycle. In 2025, that trend is playing out. Silver is closing years of underperformance and signaling that the laggard may become a leader.
Like, let's say the dot-com top, NASDAQ 100, for example. When it turned down, S&P went down 2 years to 2002, 50%. NASDAQ 100 went down 82%. You talk about cleansing, okay? And it wasn't that what it was up there for was wrong. In fact, the dot-com bubble was totally valid. It changed our lives more than people even thought, and the internet did. And yet it still erased 82% of it, and it took it till 2016 for the NASDAQ to even get back to the price it had been in 2000. So, the point being that a lot of these things that happen, like if the stock market's going to top, as we argue it's topping, or the monetary metals are going to accelerate now, it's because of not factors that are necessarily new headlines, but old stuff that's finally getting recognized. And I think that's where we are, at a very dramatic point, especially for silver. Gold, okay, I think it's telling us that, one, it's anticipating, and remember, gold's not some dumb market that follows headlines. There might be a day here or there where, something happened in Iran, we dropped the bomb and therefore, whatever. These excuses come and go. People like to latch onto them and say, well, that's why it happened, okay? But it's ongoing, and gold knows that if, one, we have the biggest stock market bubble in U.S. history, which we've been arguing you do have, both in terms of age of the bull market, most of the bull markets in the past that we call bubbles, like the dot-com or 29, they were only 4 or 5 years. And the multiple gain was like 3 or 4-fold at most.
Markets are not linear. Excesses build, and when they must unwind, the adjustment can be brutal. We've seen it in past technology bubbles, debt cycles, credit crises. When a trend becomes overstretched, even continued monetary easing may fail to prevent reversals. In those moments, investors flee perceived risks and rotate toward flight to safety assets. In many bear phases, gold actually rises even as equities collapse. The story of 2000 to 2002 and 2007-2009 illustrates how money often migrates from broken markets into metals, and that may be happening again.
and then you still collapse. Well, we've gone up, 20-fold in the NASDAQ since 2009. S&P's gone up maybe 10, 11-fold since 2009 low, which because, 700 level on the S&P. And the duration has been like triple the norm. And you can look at a money supply chart or a Fed funds rate chart, the short end of the market, of the debt market, and see why. Because we've been given a Cheech and Chong injection of happy money, free money. In fact, 10 of the last 15 years, the rates were effectively zero. You go back 75 years, and even when they raise rates to 5%, that's low compared to the last 75 years. That's in the lower quadrant of the rate levels. Okay, so the stock market's been fueled by free money. And that's why, like, the stock market's up today. Why? Great unemployment report. Why is it great? Because it means the Fed's going to cut and print. They got more excuse to print. And that's all we care about. Give us more injections, boys. And that's in effect, it's a miniature Venezuela market. Print the money, will go up, okay? So will the price of... When I was a kid, a loaf of bread was 20 cents, okay? What is it now? When your granddad built a house, it cost, the median price was $4,500. Now it's $450,000, okay? What does that reflect? Degradation in the money unit, period, okay? And when the Fed has more incentives in this ECB and the Bank of Japan have more incentive to print, that money goes somewhere. Now, quite often it'll go to the stock market, but even the stock market historically will get to a point where it says, golly, I've gone too far with this game. And it breaks. And when it starts to break, people with assets who are smart will begin to get out and move somewhere else. It's never the case where everything goes down. That argument is not true. Gold has always risen in bear markets. Back in the 1930 to 32 bear, after the crash, we had a big rally in the stock market back halfway to the high, and then the bearish market started. It went down like 80%.
Right now, 2025 is shaping up as a standout year for gold and silver. Gold recently broke new records above $3,900 per ounce, with strong flows from institutional and sovereign investors driving momentum. Silver, meanwhile, has surged on tight supply and increasing industrial demand, pushing toward multi-year highs. Gold remains favored by central banks, but silver's dual role, monetary and industrial, gives it optionality. Analysts caution, though, that silver's rapid rise may invite technical volatility.
Gold miners, you couldn't buy gold because it was illegal. Okay, government knows best. But homestake mining went up like 1,000%. Okay, during the huge bear market in stocks. Similarly, 2000, 2002, stock market went down big. What did gold do? It was advancing. It kept advancing till 2011. 2007 to 2009, stock market went down big. During that time, except for a month or two in there, an interruption, gold went up big and continued on up big. So the money goes elsewhere. Gold is getting some of that money already, certainly not from U.S. investors, but from foreign investors, governments as well. But when the U.S. stock market shows another fracture, not that headline chasing sell-off that we had in April, tariffs would sell it, okay? The reason for the market to go down is not some new news. It's based on, one, the massive excess of the past 15 years finally has reached a point where even if they keep printing, it won't help. Why? Because in 2000 to 2002, the Fed printed like crazy to save that bear market from happening. It didn't work. They started cutting rates in 2007. In fact, that's what printed the top. Well, gold's more dramatic this time, obviously, okay? But that's only on a point scale. Right now, a lot of people are looking at gold and think, well, gold's going ridiculously. It's look at a huge amount of dollars up. But actually, in net terms, it's still not, it's approaching halfway of what happened in 79 to 80 and what happened in the 2000 to 2011 bull market. They were both 8-fold gains from prior bear low to prior bull high. And ultimately, late in the move, you understood why. Oh, yeah, okay, now I understand. First, an asset class movement out of a degrading asset that had been bubbled, and it broke. The money went somewhere, usually went into T-bonds or gold, or both. This time, it's primarily gone into gold. T-bonds have been in a lateral range for 3 years.
What comes next? The broad macro forces, money printing, currency stress, capital rotation remain in place. Gold still has space to run before matching earlier bull multiples, so present levels may still feel early in the cycle. Silver's upside is more volatile but stronger in percentage terms. Some analysts warn that silver's squeeze may ease, especially as inventories rebuild. The key test will be whether broad markets crack under their own excesses. If stocks falter, capital is likely to move aggressively into monetary metals. Gold first, silver soon after. That's the narrative this cycle looks set to follow.
And that's its primary driver. And we're not even close to the metrics, the dimensionality of those moves. So people who are arguing, they look at a price chart, oh my gosh, this is too much, too fast. You're looking at dollar terms, look at percent gain. Gold has to go to $8,500 to match the percent gain that it had in the 1980 peak versus its 1976 low, or from its 2001 low to its 2011 high, eightfold move. We'd have to go to 8,050 because our bear market low was 1,050. Okay? So we're not even started in terms of catching up to those. And I think a lot of people miss that. And the reason is those basic long-term underlying asset flows. The Fed creates degradation of money, the money goes somewhere. And when they accelerate the degradation of money and the investors finally decide, I'm not going to keep playing the game we've been playing because I perceive risk, stock market, they move it somewhere. And I think that the place they're going to move it now, more so, is into gold and silver, but also into basic commodities. Commodities are vastly underpriced historically to themselves and to other asset categories. Like the Bloomberg right now is around 104 or 5. Its high in 2008 was 237. Okay, so we're not even halfway to it. So anyway, this is the main driver. It's not so much a specific thing. It's the broad context. And yes, some of these specific things help explain that. And right now, certainly the stock market doesn't care about, quote, economics. It cares about, a bad number, bad economy, great, Fed's going to print. Well, that drugged out game historically never continues. There's a point at which it finally breaks on itself. I think we're there. Our technicals say do not trust this stock market. A new high by 10% by the S&P over the January high. You wobble back down a few more percent points, you're going to go back through that high. And then people will say, I thought we had a breakout. That's when the panic's going to hit. Meaning the people in the stock market who felt comfy will suddenly feel uncomfy. And they'll go to where, it's comfort.